it's a monetary loss as well as a loss of confidence. But I think you've got to put it into perspective. Cryptocurrencies have always been plagued by problems, going back to a lot of problems with things like Mt. Gox, the problems we had last year. So in one sense, it's nothing new. But the thing is, you've got to put it into context. The losses in cryptocurrencies pale into insignificance when you compare them to the $30 trillion worth of write-downs in assets, which are going on in equities, they're going on in bonds, they're going in private market assets, in housing. So it's part of an overall adjustment in valuation.
Okay, so then what do you see as the fundamental problems in the crypto sector then? Why is it all seemingly imploding right now?
Well, I think you have to separate crypto into two bits. One is the payment mechanism, which is currencies, which are seeking to replace or displace, in part, normal fiat currencies around the world. And that's where the problems have been, because they haven't fulfilled their purpose, because they can't act as payment mechanisms, and probably now people are starting to sell them off for a whole bunch of reasons. And on the other side, you have to talk about the underlying technology, which is blockchain, which may, and I stress may, be able to be used for other applications in finance. And the most common one that people talk about is decentralized finance. But the problem is, as was reported earlier this week, the Australian Stock Exchange has just written off $250 million cool dollars in terms of their project to use blockchain for basically custody arrangements. So I think cryptocurrencies are being sold off for one set of factors, but it's contaminating the potential more generic applications of the underlying technology.
Because with respect to blockchain, I mean, there are some out there who say that it has some very purposeful use cases.
Well, I think there is some potential uses, but I think the case is still to be convincingly made. The reason being, basically, what it allows you to do is attest and establish title to something. Now, we have very, very good established ways of doing that, like custodial agents, exchanges, governments in terms of central banks standing behind currencies. So the case that blockchain will be better, other than the fact, essentially, that it's not backed by a government, which is actually proving to be a problem with cryptocurrencies, is not convincing. And I think that's the major problem. And I think one of the most amusing things about the current meltdown in cryptocurrencies is the fact that the whole movement was predicated on displacing governments. The fact that they would be independent and this would be a complete new reality. And they tapped into a lot of populist anger and sentiment in doing that. But now at the first sign of major problems, they're all running behind mother's skirts and going, we need regulation, we need the government to bail us out. So you've got to make up your mind. You're either part of the system or you're not.
If we can go back to the 20s, John Kenneth Galbraith in The Great Crash described bezel theft, where there's often a lengthy period of time between the crime and the discovery of that crime, where the person being robbed continues to feel richer because they aren't aware of their losses. Are investors today ignoring bezel at their peril?
Well, I think this has been going on since QE started in 2008, 2009. Once you made money free, everybody took on more and more risk. And that created a very febrile environment in which lots of people basically sold snake oil to other investors who were desperate for any sort of return. And so what happened is they all played a Ponzi game where the price kept going up because it was essentially one fool sailing to a greater fool. And that's been going on for about 10 or 12 years. And those games always come to an end. So one way to think about the cryptocurrency problems at the moment is it's part of essentially the great financial bubble, or the everywhere, everything bubble being pricked. And that's being pricked by higher interest rates and a general move to somewhat greater degrees of financial sanity as financial gravity starts to exert itself, because interest rates are now much, much greater, and also overall growth prospects are much lower.
So do you expect there to be any contagion at all after the FTX collapse to the broader financial market? I mean, could it be as bad as the GFC?
Well, I think the most important thing is, I think if you look at the losses overall, the losses of 30 trillion plus are comparable to the GFC, but nobody's really taken much notice of it. But the FTX problems, the problems in the crypto space, may not be as contagious as, say, the mortgage collapse in 2008 was. And the reason for that is most people don't seem to grasp that the cryptocurrency space is not integrated into the financial system. So they're not linked into banks, they're not regulated. There's a whole other ecosystem which exists out there. So we are waiting to see if there's going to be some contagion. The most direct line of contagion we can see is twofold. The first is a lot of people, supposedly some very, very smart people like the Ontario Teachers Pension Fund, Sequoia Capital, which is a very big VC fund, SoftBank, which now seems to be a serial loser in terms of its tech investments, and also the very conservative Singapore government, Temasek Investments, put a lot of money into FTX. And at least the Singaporeans have admitted that it was a terrible mistake. But other than those investors, I don't know what link there is to the main financial system. But I think what you're going to see, and that's what I'm waiting to see, and it will take some time, is the whole area of private investments. Because remember, most of the crypto investments exist in the private market. Very little of it's traded. The valuations are opaque. But a lot of Australian super funds and pension funds around the world have invested large amounts in private assets. And these are valued periodically and in a very, very non-transparent way. And some of the funds in Australia, for instance, have up to 20% of their assets in these private markets. So as these are revalued, it'll be interesting to see what the losses are, and that will flow through into people's wealth, because clearly if these are marked down, their super funds, etc., will get written down. And that's when I think we can be able to judge what contagion effects there are.
So who or what do you think is responsible for the ballooning crypto sector that we've seen in recent years?
Well, I think it's several things. It's never one thing. One is low interest rates and the abundant liquidity that the central banks pumped in, first after the global financial crisis and then during the COVID-19 pandemic. And essentially, that's the first factor, because if money is very cheap or free, then obviously that encourages certain types of behaviors in search of returns. The other thing is people have been looking for growth. The world's growth has slowed, so everybody's looking for the new best thing. So there's almost a fear of missing out, as the people called it. So people basically have been chasing lots of those sorts of instruments. And under those circumstances, as in all booms, there is a whole bunch of people who are very skilled in terms of exploiting investors' desire for rapid riches.
Well, we're seeing a reversal of those riches now. What could be the impact on the economy with both? We've got the destruction of public money as quantitative easing is reversed and interest rates rise, and the destruction of value of private cryptocurrencies. So how will this double whammy hitting private wealth feed through to demand and inflation?
Well, I think you've got to look at it in two parts. One, clearly, there's going to be a wealth effect. People have lost money. A lot of that's paper wealth, so it's not going to be cash. You sort of put $10 in, and suddenly it was worth $1,000, and you thought you had $990, which you didn't really have. But that's neither here nor there. But the fundamental thing is if people feel less wealthy, then they'll spend less. So that's the first demand destruction element to that. Then you've got to see, well, okay, if that flows through into investors, if it flows through into banking systems and so forth, there's less money around. So there's less money around in terms of credit and general for investment. So that's the first element. And of course, the second element of that is inflation. Now, inflation has a demand component and a supply component. Now, basically, the central banks are trying to choke off the demand component, which is through interest rates. Now, if there is a simultaneous wealth meltdown, then obviously demand will come down. But the problem is, inflation may not come down because it's supply driven. And last time I looked, cryptocurrencies or interest rates aren't going to have a major impact on the Ukraine war until the central banks can resolve that, or on the oil supply, or on the scarcity of energy, or on the scarcity of materials to make the energy transition feasible. So all of those things are going to play out. And I think at the moment, the jury's still out as to how all of those factors will interact.
Des, I'm keen to find out from you on whether you think the crypto crash is feeding into the tech sell-off. I mean, are they independent of each other, or are they both just symptoms of a common disease?
Well, I think there is some commonality, but I don't think it's actually common in the sense that we've seen probably Meta, the old Facebook, lose about $700 billion. We've seen Amazon lose about $1 trillion in market valuations. Tesla's lost about half. And I think there's several factors underlying that. One is that most of those businesses like Meta and Google and people like Amazon rely heavily on two things, which is economic activity, and the second thing is advertising. And if economic activity is easing, then basically that's going to affect them. And advertising generally has been weak because of the lack of demand growth. So I think those factors are playing out. And also I think one of the things is that low interest rates led people to spend money rather interestingly in lots of projects. If you look at Meta, if you look at Google, you look at Amazon's balance sheets, they have amazing projects which produce no revenue. They have probably one or two businesses which are profitable. The classic is Amazon Web Services, which makes all their money. The marketplace stuff doesn't make much money. So essentially, people are now having basically a cold shower and sitting down and saying, okay, we can invest in bonds at 3 or 4%, whatever the rate is. So let's have a look at these businesses and see what their revenues are. And then if you discount those revenues, which aren't as promising, at higher interest rates, and you present value them back to today, they don't look so attractive. Now, it's simple mathematics. If rates go up 3%, a dollar paid every year over, say, 15 years is worth 19% less. So what we're seeing is a whole mishmash of factors affecting valuations. But this has been coming for 4 or 5 years. It's not a surprise to anybody who's been actually looking at it carefully.
Das, we are running out of time. I've just got a couple more questions for you. Do you see any bigger threats to the stability of the global financial system? What is the runaway train we should all be looking out for?
Well, I think there's two runaway trains which have been running away for a while. One is geopolitics, and the other one is deglobalization, particularly in the form of sanctions and trade restrictions which are accelerating around the world. And that has a tendency historically to destabilize growth and economic prosperity fairly radically, as we saw in the 1930s and around just before the First World War. So I think those are the two things that people should be watching very carefully.
Okay. With respect to what we've been discussing with respect to cryptocurrencies, where does this leave the central bank here in Australia, which is in the development of their own digital currency, and others are around the world as well? Where does it leave them?
One of the issues with introducing central bank digital currencies, it has enormous effects on the banking system because essentially you're replacing deposits with CBDCs. But the second element is in crises, particularly if it concerns the banking system, people will take more money out of banks and stick them into CBDCs, which will create some financial stability issues. And I think central banks know this. So I think they'll be very, very cautious. And to some extent, I think what we will see is a slower pace, and I would not be at all surprised to see very little action. And to some extent, I think the excuse that the central banks will use is, well, we asked industry to give us some applications for CBDCs and for blockchain and so forth, and that hasn't been forthcoming. So under those circumstances, we don't think the risks are worth it.
So is regulation the answer here? Can that fix the problem, give crypto a better-looking future?
Well, I think the first thing is, if you look at crypto, the whole point of it is it's not regulated. It's a decentralized model where it's you and me who decide what goes on in the world of money and custody and ownership of assets. So to have the idea for centralized, in this case, a government regulating is an oxymoron. So that's the first thing. The second thing is, okay, how are we going to regulate it? Particularly given that there are certain regulations already in place, things like misrepresentation, fraud, and so forth, it already exists. And the third thing is, if you regulate it, there are some consequences. If you regulate anything, you bring them within the financial system. So if anything goes wrong, then the central bank and the banking system, etc., will have to step in to help them. So our governments, who barely understand this, essentially going to be willing to take on that risk. And the last issue is one of the beauties or problems of cryptocurrencies is they're not national. They're usually located in tax havens and all sorts of other jurisdictions. So basically the only way you could really regulate them meaningfully would be to have international regulations which is consistent, coordinated, and enforced across all jurisdictions. And I can't see that happening anytime soon. But I think there will be some grandstanding by certain politicians in terms of trying to regulate the sector.
A central debate around crypto tends to centre around power through the control of money supply. Is crypto ultimately a social movement or a financial one?
Well, I think the social movement is primary. I can understand why people went to cryptos. It was populist anger. One way to think about it, this is the financial manifestation of Brexit and Trump. This is disillusionment with the existing system. This is disillusionment with inequality and the fact that people feel that a small group of elites rigged the system, and the system is rigged. We all know that. But the crucial thing is, how can you replace one system with the other? The libertarians who are behind cryptocurrencies are basically not actually Democrats. They just want to replace their control with somebody else's control. And Mayer Rothschild, who was a very famous member of the great Rothschilds family, once said that he did not care who was the puppet sitting on the throne of England. And the reason was that whoever controlled the money supply actually ran the British Empire, and he ran the money supply, so he couldn't care less who was king. And I think fundamentally that's the debate that's actually going on at the moment.
Fascinating to speak to you, Shruta Das. Thank you very much for your time.
It's my pleasure.